Welcome back, traders. So let's get started. Clearly identifying whether a setup is truly high quality or not is one of the most important parts of trading, and that's something we already covered in previous episodes. Those hacks help us filter out risky trades, but they only serve as the first layer of confirmation. If you want to add more confluence, more depth, and more validation to your setup, and truly reach A-plus entries, then you need a second layer of confirmation. I personally use 4 important hacks to add more validation to my trades, depending on the setup. So now, let's go through them one by one in detail and see how to use each of them effectively to reach A-plus entries with extra confirmation. Starting with the VSR pattern. VSR stands for V-shaped recovery. The basic idea behind this pattern is simple. When price grabs liquidity or reaches a strong demand zone, it may drop sharply and then recover strongly back to its previous level, forming a clear V shape. In a bearish scenario, the opposite happens. Price rises quickly, grabs liquidity, or reacts from a key supply zone, and then drops back to its previous level. This creates an inverted V-shaped pattern. A V-shaped recovery shows that a large volume of orders has entered the market. In other words, it may indicate that smart money has stepped in, and that a strong reversal could be about to happen. Since we always want to trade in the same direction as smart money, not against it, the V-shaped pattern gives us an extra layer of confirmation and validation before entering a trade. So, the main reason we want to see a V-shaped pattern is that it can signal smart money entry, which may lead to strong buying or selling momentum. However, it's important to understand that not every V-shaped price movement is valid. Not every sharp drop and recovery should be treated as a true V-shaped recovery or a real sign of smart money entering the market. We should only focus on V-shaped patterns that form after price grabs liquidity from a major key level or after price reacts from an important supply or demand zone. Also, here's another pro tip to remember. V-shaped patterns become much stronger when they are formed with inefficiency. In other words, when both the upward and downward legs of the V-shape leave behind regular or inversion fair value gaps, the pattern becomes more reliable and the probability of an upcoming reversal increases. For example, as you can see here, price suddenly drops, forms a swing low, and after tapping into a higher time frame demand zone, quickly rises back to its previous level, creating a clear V-shaped pattern. This move also leaves behind a new demand zone and a fair value gap. This V-shaped recovery shows that price found support at the bottom and was pushed higher by strong buying pressure, suggesting that smart money may have entered the market. So, when this pattern appears, especially alongside a market structure shift such as a change of character, it adds another strong layer of confirmation and increases the probability of an upcoming uptrend. As a result, you could consider looking for a long position to take advantage of the potential move higher. Now, let's move to the next confirmation hack, CISD, change in the state of delivery. The second hack on our list is CISD, which means a close above or below the series of bullish or bearish candles that led into an internal or external liquidity sweep, or into the mitigation of a key zone. In a bullish scenario, a change in the state of delivery happens when price closes below the body of the first candle in the series of bullish candles that led into the liquidity sweep or higher time frame point of interest mitigation. Similarly, in a bearish scenario, CISD happens when price closes above the origin of the series of bearish candles that led into the liquidity sweep or higher time frame key area mitigation. Adding this extra confluence to your checklist before placing any trade gives you a much better chance of filtering out early entries from fair value gaps and inversion fair value gaps inside the mitigation leg or liquidity grab leg. In other words, it helps you avoid entering too early before the market has actually confirmed a change in direction. On top of that, waiting for CISD helps filter out invalid or early V-shaped recovery patterns and prevents you from making rushed and unnecessary trading decisions. In other words, CISD helps you avoid entering too early before the market confirms a real change in direction. This matters because many traders enter right after a liquidity sweep, thinking the reversal has already started. But price can still move deeper into the higher time frame zone, rebalance more inefficiencies, or even create another liquidity sweep before the real reversal begins. So instead of guessing the reversal just because price touched a key level or swept liquidity, CISD allows us to wait for confirmation that the previous delivery has actually changed. That's what makes CISD powerful. It shows that the aggressive move into liquidity or a key zone is losing control, and the opposite side of the market is starting to take over. Now let's move to the next filter, the double sweep confirmation. The next second layer confirmation is one of the most important rules in smart money trading. Always wait for a major liquidity side to be taken before applying your trading model. That means we do not want to enter just because price reaches a key level, reacts from a zone, or creates a small confirmation on the lower time frame. Before applying our model, we first want to see price take out a major liquidity pool on the higher time frame. This could be buy-side liquidity above a clear high or sell-side liquidity below a clear low. Why? Because smart money usually needs liquidity before making the real move. A lot of traders enter too early while price is still moving toward liquidity. They see a fair value gap, an inversion FVG, a small structure shift, or even a V-shaped reaction, and they immediately assume the reversal has already started. But in reality, price may still be targeting a much larger liquidity pool. So instead of entering in the middle of the move, we wait for price to complete that liquidity run first. Once that major liquidity side is taken, then we can start looking for the actual entry model. That already gives us better context, cleaner setups, and a much stronger reason to trust the reversal. But here's what makes the setup even stronger. After price sweeps the major higher time frame liquidity, do not enter immediately. Wait for price to also sweep the internal liquidity created right after that first sweep. In a bullish setup, price may sweep a major low, bounce, attract early buyers, create internal lows, and then come back to sweep those internal lows before the real reversal begins. The same logic applies in a bearish setup. This is important because smart money does not always reverse immediately after taking old liquidity. In many cases, price first sweeps the higher time frame liquidity, then clears the newly created internal liquidity, and only after that does the real reversal begin. That means both sides of liquidity have now been cleared. First, the old liquidity resting above or below the major higher time frame level, and second, the new liquidity created by early traders inside the lower time frame order flow. And that gives the setup much more strength and confirmation, so the sequence should be clear. First, wait for the major higher time frame liquidity sweep. Then, wait for the internal liquidity sweep. After that, wait for a market structure shift or change of character with displacement on the lower time frame. Once displacement appears, you can look for your entry from a fair value gap, order block, or another valid PD array inside that displacement leg. That is what turns a basic liquidity sweep into a high-probability smart money